What's going on, my fellow wealth creators? Matty Ice here. I am so excited to do this video because I just got approved for my second infinite banking policy. I just sent over the ACH form and certificate of insurability. And I'm fired up, man, because these things are so freaking powerful. And what I want to do in this video is break down my actual policy here. This one is set up with One America. They have some really, really cool features in these policies that I'm going to go through. But I want to show you how I designed the policy and talk a little bit about why I'm doing this as well. And actually, you know what? I'll start with that because, you see a lot of, and I've created content about this, and, there's a lot of stuff, a lot of really misleading information out there about whole life insurance. They say it's a terrible place to put your money. And, oftentimes the way they talk about it, that is the case because they're typically talking about traditional 100% base policies, designed for like final expenses and things like that. And those are not great places to put your money. But these max funded, cash value, dividend paying whole life insurance policies can be absolutely fantastic. And I'll tell you this, guys, when you learn how these things actually work, you get excited to to start additional policies. Like I've been chomping at the bit to get this thing done and to get my second policy because there's such a fantastic place to store capital, to store our safe money for our emergency and opportunity funds. And we just get so many benefits from it. And the fact that we can access a large portion of our cash value in the first year, which I'm going to show you here in just a second, why not set these policies up? Especially if you're a business owner and real estate and all that. And, the way I think about this is I've basically just started the second branch in my banking business. That's what it feels like to me. That's the philosophy that I have around this is I'm starting another branch in my banking system because that's what these policies basically create for us is our own privatized banking system where, there's tons of benefits that we can go through, but these policies are going to get that guaranteed growth every single year, plus dividends, which are not guaranteed. But, these companies have never missed a dividend payment. The ones that we work with, One America, I think has been paying dividends for 146 years, right? But, we're going to get that growth in the policy. It's uninterrupted tax-free compound growth, which, you start early enough and you give it enough time can blossom into a very, very large amount of money. Cash value later on down the road. But then we have the ability to access that money without interrupting the compound growth so that we can continue to build wealth. And so the more we capitalize our banking system, the more opportunity we can take advantage of. And that's why I'm so excited to set up the second policy. It's just I'm adding to the capitalization of my banking system. And, this year I'm getting into private money lending on real estate. I'm flipping heavy equipment and, I'm exploring these different wealth building strategies. And the more capital I have access to, the more I could take advantage of those opportunities. And it accelerates me building wealth and me reaching my financial goals because, I'm taking advantage of these other opportunities, but I'm also getting all of these other benefits like the uninterrupted tax-free compound growth. And whenever the deals are done or, and I'm building wealth over here, I take that, I put it back into my policy and I keep you just rinse and repeat the process over and over again. So it's such a powerful strategy. Infinite banking, the infinite banking concept is so powerful. And there's no better vehicle on planet Earth, at least that I found, to implement the infinite banking concept than these dividend paying cash value whole life insurance policies. So really excited to share this with you guys. Let me go ahead and share my screen. I'm going to show you the illustration that I just got approved for. All right, so here we are. Initial death benefit 1.8 million. Annual premium is going to be 15,000. Premium paid to age 55. So this is a 20-pay policy. So I don't know if you guys are aware of this, but you do not have to pay into a life insurance, whole life insurance policy your entire life. You have coverage and you have the death benefit your entire life. You have the policy your entire life, but you don't have to pay into it your entire life. So you could do a 10-pay. I've seen some structured in ways too, where people only pay into it for 3 or 4 years. It just depends on what your situation is. But that's what another thing I love about these things is they're so flexible, and they can help. You can fit these and customize them to your specific goals and current financial situation. So I'm paying into this one, this policy until age 55. So I'm 35 right now. That's a 20-pay policy. So if I scroll down, you'll see here my contract premium. It disappears at the end of year 20. So I no longer have to make premium payments into this policy, and yet the policy is going to continue to grow every single year because I get that guaranteed growth rate. One America right now at the time of this recording is 3.25%. I don't know about you guys. That sounds like a fantastic long-term savings account to me. Not to mention it's tax-free. Okay. So that to me is really good. And then on top of that, they pay dividends as well, which again, not guaranteed, but they've always paid them. So the premium stops at year 20. And the reason I did it this way is because my first policy I'm paying until 75. So it's like a 40-year pay. There's not technically a 40-year pay type of policy, but I have it set up to pay into it until 25, until 75, which is 40 years. And in that one, I'm doing $25,000 per year. In this one, I'm doing $15,000 per year. So this is forcing me to save, to be responsible with my money. And it's forcing me to save $40,000 into my banking system every single year. That is awesome. And it doesn't overstretch me or anything. And not to mention that, with paid up additions, I don't have to put in $15,000 in a year. I'm not on the hook for that, but I want to. I absolutely want to do that because that's more capital going into my banking system. All right. So I have this set up as a 25-75 split, just like I did my first policy. So it's 25% base premium and then 75% paid up additions. That's how I like to set up my policies. Everybody's a little bit different. I might do something a little bit different later on. And of course, your situation will dictate how you want to customize that based on your situation. But I like the 25-75 split. Gives me a little bit more of that permanent death benefit right up front. I really want the death benefit because I'm thinking long-term, guys. I want the death benefit to be able to pass that on as a legacy play later on. But also I'm preparing for when I get old and something happens. I mean, we eventually break down, right? And we need that long-term care. Well, the larger your death benefit is, the more of those living benefits you have access to as well. So I'm thinking long-term with that as well. So I definitely want a good amount of death benefit. But that's kind of the overall structure of the policy. It's a 20 pay. We're doing $15,000 per year. My other one is $25,000 per year. So I'm going to be capitalizing, putting $40,000 per year into my banking system. All right. And, pretty good amount of death benefit starting out. Now, let's look at the first year here. So you see 70,000 and then 15,000. So what that means every year after that. So 70,000 the first year. That means I'm putting a lump sum payment into the policy. In this case, it would be, what is that, 55,000. So on top of the first year's premium of 15,000, I'm putting an additional 55,000 into the policy to basically kickstart it, supercharge it. This is how I always recommend setting up policies if you can, and why, if you're not able to put like at least $10,000 in the first year to as like your first year, like you don't have to do that every single year, but as your first year to like kickstart the policy. That's I usually recommend holding off if you're not able to do that. Save up the 10,000 and then maybe you pay 2,500 per year. That's kind of like the minimum that I would usually recommend. But guys, this is how you set up these infinite banking cash value whole life insurance policies for really good cash value in the first year. Look at this. My total net cash value in the first year is $64,000. That's huge. That's awesome. Little bit of a hit, but that's fine because we're starting. I'm starting another banking a branch in my banking system. Like, whenever I hear this, like, why would you take a hit of let's call it $6,000? Because I'm starting basically a banking business here. Like when you start a business, there's going to be costs associated with that in the beginning. Like a lot of businesses aren't even profitable until many years down the road. So I don't really understand that argument. We want to pay, like this is a small cost, a small price to pay to set this type of system up. But as far as like design goes, this is fantastic. $64,000 of cash value in the first year and I started with 70,000. That is really, really good. And I'll have access to roughly about 95% of this. So we'll call it $62 or $63,000 that I will be able to borrow against within the first 30 days of the policy being issued. That is really good liquidity, guys. So on top of the other policy that I already have as well, right? So that's one of the reasons why I love doing a lump sum up front, because it's supercharged. It like just kickstarts the policy. It supercharges it. You get access to a ton of cash value in the first year. Even if you don't do a 10-90 split, like 10% base, 90% paid up additions, you don't have to do that in order to get access to a ton of cash value in the first year. So that's why I love this setup. It is just awesome. And my break-even point is year 5. So I wish they had a cumulative premium outlay column here. Maybe I can customize that. I'll have to check. But anyways, by year 5, I've put in 130,000, and my net cash value is 131,000. So I break even year 5, and then it's growth after that. Okay, that's a pretty good break-even point. My other one, I break even between year 3 and 4, so it's very, very close. All right. The other thing too, though, is my policy starts to grow by more than what I put in every single year very early on as well. So I think it's is it year 4? Let's see, 14, 15. No, and actually it's year 3 right here. So look at this. I'm putting in $15,000, but my cash value grows by, what is that? $16,400 right here between year 2 and year 3. I'm sorry. So between year 2 and 3, when I make my $15,000 premium payment, my policy actually grew by $16,400. So my policy is already growing by more than what I'm putting into it by year 3. That is, I mean, this is how you do it, guys. High cash value first year, early break even year, and your policy starts growing by more than what you put in every single year within the first 5 years of the policy. If you can set that up, you have yourself a really good infinite banking whole life insurance policy here, guys. And that's just going to continue to grow and grow over the course of however long. 20 years right here is when I stopped making premium payments. Oh, the other thing that I wanted to mention was you'll notice here that my death benefit drops off pretty significantly. This is I did a 10-year term policy on this one so that I don't mech the policy. You typically do have to add at least a 7-year term life insurance policy to these whole life policies to make sure you don't mech them and lose all the tax advantages. So we don't want to do that. But I did a 10-year because I wanted to give myself a little bit of wiggle room to convert that term life policy into another whole life policy later on down the road. And plus, I wanted the death benefit a little bit longer as well. But typically, you do a 7-year. I like doing 10 years now, but it just depends on what you're looking to accomplish. And also the reason I did 10 instead of like 20 is my first couple of policies, I want to focus a little bit more on efficiency. And the longer you have the term policy on your whole life policy, it's a little bit of a more of a drag because you have more costs. So it's more drag on the internal rate of return and efficiency, et cetera. It's not going to make a huge difference, but little things do add up like that. So my death benefit drops off here because the term life policy is canceling. But, I'm okay with this amount because it's very similar on my other policy as well. So even after these things fall off, I'm still going to have a good amount of death benefit. And from there, it's just going to continue to grow. Let's see. I think that's about it. Those are the main things that I wanted to cover in the policy. I don't think I forgot anything. Yeah, that's it for now. I'll probably do other videos on it later, but I wanted to show you guys how I set it up and how I typically set my policies up for high cash value, early break-even year. It starts growing by more than what you put into the policy very early on in the policy as well. And that's how you want to set these things up. And, just like my other policy that I'm using for the infinite banking concept right now, I'm going to do the same thing here. I have to start getting more deals into the pipeline, like my real estate stuff. So I can put this to use. But regardless, it's going to continue to grow, get that uninterrupted compound tax-free growth every single year. And as opportunities present themselves, I'm going to be able to borrow against these policies, take advantage of those opportunities, and accelerate the wealth building process. It's awesome. You can't beat this. And it's why, like, when I hear people talk smack about these things, it just doesn't make sense. Like, if you think about these things logically, once you understand them, it's a no-brainer. Like, I don't see how anybody could say anything bad about this. It really doesn't make sense to me. But then again, everybody's goals are different. So, this aligns with my goals very, very well. So anyways, I hope you guys are crushing it. I hope you found this video helpful. If you have any questions, drop some comments down below. If you want to consider look at setting up something like this in your life so you can implement the infinite making concept, feel free to book an infinite making coaching call with me and my team. Happy to have that discussion and see if it's a good fit for you. All right. So I will talk to you guys in the next one. To your success. Matty Ice is out.